Stocks. Buying ownership in a company. You purchase shares on exchanges like the NYSE or NASDAQ. When the company profits, your shares increase in value. You buy in and watch the numbers move. A tech stock jumps 15% in a week. Your portfolio shows green. It feels effortless. That's the rush. When stocks rise, they explode. A company announces record earnings and shares jump 30% overnight. You check your account constantly. Every refresh shows more money. The gains feel unstoppable. Then the market crashes. News changes. A recession hits. Your portfolio bleeds red. Those gains vanish in days. Panic sets in. Most people sell at the bottom, locking in losses. Stocks average 7 to 10% annually long term, but most investors earn 3 to 5% after fees and emotional trading. They buy high, sell low, and never recover. Stocks build wealth only through patience and discipline. Time in the market beats timing the market. Bonds. A loan you give to governments or corporations. They pay you back with interest over time. It's the safe investment, the one that doesn't crash. You buy bonds for stability. No wild swings, no panic, just predictable returns. It feels secure, controlled, and boring. That's the point. Bonds pay interest consistently. Government bonds rarely default. Corporate bonds pay higher rates with slightly more risk. You earn just for lending money. Then inflation arrives. When prices rise faster than your bond's interest rate, you lose purchasing power. A 3% bond means nothing when inflation hits 5%. You're losing money silently. Bonds return 2 to 5% annually depending on type and economic conditions. They won't make you rich. They won't wipe you out either. The trade is growth for safety. Bonds are insurance, not wealth builders. Essential for retirees. Too slow for young investors. Real estate, buying property to rent, live in, or flip for profit. It's tangible. You can see it, touch it, control it. You buy a property and collect rent. Tenants pay your mortgage monthly. That cash flow feels powerful. You're building equity while someone else pays the bills. Property values double. A $300,000 home sells for $600,000 5 years later. Tenants covered your mortgage the entire time. Leverage amplifies everything. 20% down controls the whole asset. Tenants stop paying. Repairs drain your savings. Property taxes rise. The market freezes and your property sits unsold for months. Real estate is illiquid. You can't cash out instantly like stocks. Real estate appreciates 3 to 4% annually on average. Add rental income and total returns hit 8 to 12% before expenses. After maintenance, vacancies, and taxes, real returns sit at 6 to 8%. Real estate builds wealth but demands time and capital. It's a second job disguised as passive income. Index funds. One purchase buys hundreds or thousands of companies simultaneously. The S&P 500 index owns America's 500 largest companies. Instant diversification. You don't pick stocks. You don't time markets. You buy and hold. It's investing on autopilot. No research, no stress, just consistency. Index funds deliver steady growth. They've averaged 10% annually for decades. Your money doubles every 7 years. No decisions required, just time and patience. There's no excitement. Index funds don't skyrocket overnight. When markets crash, your fund crashes too. You're not protected, just diversified. You'll never beat the market because you are the market. Index funds return 7 to 10% annually after inflation. Not flashy, reliable. Warren Buffett recommends them for most investors. Index funds won't make you rich overnight. They'll make you rich eventually. Start early, never stop. Cryptocurrency, digital currency on blockchain technology. Bitcoin, Ethereum. Thousands of coins promising decentralization and explosive returns. You buy Bitcoin at $30,000. A month later, it hits $45,000. You're up 50% while index fund investors made 2%. The charts move 24/7. Every refresh is a gamble. Crypto explodes. Bitcoin went from pennies to $69,000. Early investors became millionaires overnight. Altcoins pump 1,000% in weeks. The gains seem infinite. The crash arrives. Bitcoin drops 50% in a month. Altcoins collapse 90%. Your portfolio bleeds. Regulations threaten. Exchanges get hacked. Scams multiply. Bitcoin returned thousands of percent for early adopters, but most people buy at peaks and sell at bottoms. The average crypto investor breaks even or loses after fees and panic selling. Crypto is the highest risk, highest reward investment available. Life-changing or account draining. Only invest what you can lose completely. Mutual funds. Professionally managed portfolios where fund managers pick investments for you. You pay them a fee. They handle everything. An expert manages your money, someone with credentials and experience. You don't stress about what to buy. The professionals handle it. That's the appeal. Good mutual funds outperform the market temporarily. Some managers beat the S&P 500 for a few years. Your returns look impressive. Hiring expertise seems worth it. Fees destroy returns. The average mutual fund charges 1% annually. Over decades, that compounds into hundreds of thousands lost. Worse, most mutual funds underperform index funds after fees. Mutual funds return 6 to 8% before fees, 4 to 6% after. Index funds beat them consistently at lower cost. Mutual funds sell convenience, but deliver underperformance. The managers get rich, you get mediocrity. REITs, real estate investment trusts, companies that own apartments, malls, offices, warehouses. You buy shares, they collect rent, you get dividends. You get real estate exposure without buying property. No tenants, no repairs, no mortgages. Just buy shares and collect dividend checks. Real estate for passive investors. REITs pay high dividends, 4 to 8% annually. Properties appreciate over time. You earn income and growth simultaneously. Real estate returns without the headaches. REITs crash when real estate crashes. They're volatile like stocks, but concentrated in one sector. You thought you diversified, but you're all in on real estate. REITs return 8 to 10% annually, combining dividends and appreciation. Solid middle ground between stocks and physical property. REITs offer real estate returns without real estate problems, but they're just as vulnerable to market crashes. Gold. For thousands of years, gold has represented wealth. It's scarce, universal, doesn't corrode. People buy it against inflation, currency collapse, chaos. When stocks crash, gold rises. Holding gold feels like insurance. It's tangible, real. Unlike paper money, gold can't be printed infinitely. That's the security. Gold surges during crises. In 2020, gold hit all-time highs while markets panicked. Investors who held gold preserved wealth while everything burned. Gold doesn't pay dividends. It doesn't grow. It just exists. Over long periods, gold returns 2 to 3% annually, barely beating inflation. Gold is insurance, not investment. It protects wealth but doesn't build it. Belongs in portfolios at 5 to 10% as a hedge. Commodities, raw materials, oil, natural gas, wheat, copper, silver. The physical resources that power economies. Traded on futures markets, you buy commodities as inflation protection. When everything costs more, commodities usually rise. They're real assets with real demand. That's the logic. Commodities spike during shortages. Oil quadruples during supply shocks. Wheat doubles during droughts. Copper soars during construction booms. The returns can be massive and sudden. Commodities are extremely volatile. They crash just as fast as they rise. Storage costs money. They pay no dividends. You're betting purely on price movement. Commodities return roughly 5 to 7% annually long-term, but with wild swings. They're portfolio diversifiers, not core holdings. Commodities are speculation on supply and demand. Useful in small doses, dangerous in large positions. Peer-to-peer lending. You loan money directly to individuals or small businesses through online platforms. They pay you back with interest. You're the bank. You earn higher interest than bonds, often 6 to 10% annually. Your money helps real people. It feels productive and profitable simultaneously. Good borrowers pay on time. Your interest accumulates monthly. Returns exceed most safe investments. It seems like free money from other people's debt. Borrowers default. Economic downturns spike faults to 20, 30, even 40%. Your principal vanishes. Platforms charge fees. Loans are illiquid. You can't withdraw instantly. Peer-to-peer lending returns 5 to 8% for experienced investors who diversify across hundreds of loans. Beginners often lose money on defaults. P2P lending offers higher returns than bonds, but with significantly higher risk. Diversification is essential. Savings accounts, money sitting in a bank. FDIC insured up to $250,000. Zero risk of principal loss. The safest option available. Your money is protected. No market crashes affect it. No volatility. You can withdraw anytime. It's pure liquidity and security. High-yield savings accounts pay 4 to 5% currently. Your money grows risk-free while remaining fully accessible. It's the foundation of financial stability. Inflation erodes purchasing power. A 4% return means nothing when inflation runs at 3 to 4%. You're barely keeping pace. You're not building wealth. Savings accounts return 3 to 5% currently, but only keep up with inflation. They preserve money but don't grow it. Savings accounts are for emergency funds, not investments. Keep 3 to 6 months' expenses. Invest the rest. Every investment offers something different. Stocks offer growth. Bonds offer stability. Real estate offers income. Crypto offers chaos. The question isn't which is best. The question is which fits your timeline and risk tolerance. Wealth isn't built chasing hot investments. It's built understanding what you own and holding long enough for compounding to work. Start now. Stay consistent. Never invest in what you don't understand.